So you started putting money into a retirement account. That's huge. But here's where a lot of people freeze, because there's a step almost nobody explains. Money sitting in a 401k or an IRA is not automatically invested. It can just sit there as cash, doing almost nothing for years. To actually grow it, you have to put it to work. And the way most people think you do that, by picking hot stocks, is one of the easiest ways to lose. Today, I'm going to show you the boring, almost lazy strategy that has quietly beaten the professionals for decades. It's called index investing, and by the end of this, you'll know exactly what it is, why it works, the hidden fee that secretly eats your returns, and how to actually buy it. Let's get into it. First, let's kill the biggest myth in investing. Most people think it means finding the next Apple or Tesla before everyone else. Buy low, sell high, get rich. The problem? It almost never works, and I'm not just saying that. Every year, a firm called S&P tracks how professional fund managers, people with Ivy League degrees, giant research teams, and million-dollar data systems perform against the simple market average. The results are brutal. Over a 15-year stretch, the vast majority of these pros, by some measures around 9 out of 10, fail to beat that average. Think about that. If the smartest, best-funded experts on the planet can't reliably beat the market, the odds of you doing it by picking stocks on your phone during your lunch break are not good. That's not an insult, it's just the math. So if you're not supposed to pick winners, what do you do instead? You buy all of them. That's the entire idea behind an index fund. Instead of betting on one company, an index fund holds a tiny slice of a whole group of companies at once. The most famous one tracks something called the S&P 500, which is basically the 500 largest companies in America. Apple, Microsoft, Amazon, Google, and 496 others, all bundled into a single fund. When you buy it, you instantly own a microscopic piece of all of them. You're not betting on one horse and praying. You're buying the entire racetrack. And this is exactly what makes it so much safer than betting on individual companies. If you pour your whole paycheck into one stock and that company goes bankrupt, you can lose everything. It happens, even to famous household name companies. But for an S&P 500 index fund to go to zero, all 500 of America's biggest companies would have to fail at the same time. And if that ever actually happened, we would all have much bigger problems than our investment accounts. By owning everything, you make any single company's disaster almost irrelevant to you. That's not luck. That's diversification, and it's about the closest thing to a free lunch that exists in all of investing. You'll also hear about total market index funds, which take the same idea even further and hold almost every public company in the country, not just the biggest 500. Either one is a perfectly solid foundation. The differences between them are small enough that you genuinely should not lose a minute of sleep over which one to pick. Now, historically, this approach has worked incredibly well. Over the long run, the S&P 500 has averaged roughly 10% a year, which works out to about 7% after you account for inflation. Let me show you what that actually does. Say you invest $300 a month and earn that 7% average over 30 years. You personally would put in about $108,000 of your own money, but it would grow to around $360,000. Bump it up to $500 a month, and you're looking at over $600,000. And here's the beautiful part. You didn't have to pick a single winning stock. You didn't have to watch the news or time anything. You just owned everything and let time and compounding do the heavy lifting. But now I have to warn you about the silent killer of investment returns, because almost nobody talks about it. Fees. Every fund charges what's called an expense ratio, a small yearly percentage of your money. Index funds are dirt cheap here, often as low as 3 to 10 cents a year for every $100 you have invested. But many actively managed funds, the kind with a highly paid manager trying to beat the market, charge 10 or 20 times that. It sounds tiny. 1%, who cares? Here's who cares. Over 15 years, paying just 1% more per year compounds into losing more than 16% of your money. Over a full career, it can quietly cost you tens, even hundreds of thousands of dollars. Let me make that real. Picture two friends who both invest the same amount and earn the same market return for 30 years. The only difference is that one chose a cheap index fund and the other chose a pricey active fund charging 1% more each year. At the end, the cheap fund friend can walk away with a balance that's tens of thousands of dollars larger, sometimes over $100,000 on a bigger portfolio, purely because of fees. Same money in, same market, wildly different result. And remember, you'd be paying that extra money to a manager who, as we just covered, probably won't even beat the simple index anyway. Low fees are one of the only near guarantees in all of investing. And this isn't just some internet theory. Warren Buffett, widely considered the greatest investor of all time, has spent years publicly telling regular people that their single best move is a simple low-cost S&P 500 index fund. He's even arranged for most of the money he leaves behind to be invested exactly that way. When the best stock picker on earth tells you not to try to pick stocks, it's worth listening. Okay, so how do you actually do this? It depends on the account. If you're investing inside your 401k at work, you don't buy funds on the open market. Instead, you'll have a menu of options your plan offers. Scan that list for something with the words S&P 500 or total market index in the name and check that it has a low expense ratio. That one fund is often all you need. If you're investing in an IRA or a regular brokerage account, you have even more freedom. You can buy a low-cost index fund directly from major providers like Vanguard, Fidelity, or Schwab, usually in just a few clicks. The point is, this is not complicated, and it's not some exclusive club. It's available to anyone with a few dollars in an account. And once you've picked your fund, do yourself the single biggest favor in investing. Automate it. Set up an automatic transfer so a fixed amount flows into that fund every payday before you ever see the money. When investing happens automatically, you can't forget. You can't talk yourself out of it on a scary news day, and you can't accidentally spend it first. It just quietly happens in the background, building your future while you live your life. That ties into two habits that make this almost foolproof. First, invest on a schedule, not on a feeling. Put in a set amount every paycheck, no matter whether the market is up, down, or sideways. This is called dollar cost averaging, and it means you automatically buy more shares when prices are low and fewer when they're high, without ever having to think about it. Second, burn this phrase into your memory. Time in the market beats timing the market. Nobody, and I mean nobody, can reliably predict the perfect day to buy or sell. So don't try. When the market drops, and sometimes it will, that's not a disaster. That's everything going on sale. Now, does any of this mean you can never buy an individual stock? Not at all. If you genuinely enjoy it, there's nothing wrong with taking a small slice of money you can afford to lose. Call it your fun money and playing with it. The key is that it stays small, while your real long-term wealth stays parked in those boring index funds doing the actual work. Treat stock picking as a hobby, never as your retirement plan. And here's the part that trips people up emotionally. This whole strategy is boring. There's no thrill, no hot tip to brag about at a barbecue, no checking an app every hour. You buy the whole market, you keep your fees low, you add money automatically, and then you do nothing else for years. And that boredom is exactly why it works. Most people lose money by getting excited, chasing trends, and constantly tinkering. The index investor just sits still and quietly gets wealthy. In investing, boring is beautiful. A few honest truths before you go, because this is your money. The market does not go straight up. Some years it falls, sometimes sharply, and you have to be able to ride that out without panic selling. That 7 to 10% is a long-term historical average, not a promise, and definitely not what you'll earn every single year. And how you should invest depends on your own age, your goals, and how long until you'll need the money. So take this as the foundational concept it is, not as personalized advice for your exact situation. But step back and look at what you've now got. Start early, so compounding has decades to work. Use the right accounts, like a Roth IRA and your employer's 401k match. And invest simply in low-cost index funds. That combination, used patiently over a lifetime, is genuinely how ordinary people build real wealth. No lottery tickets, no get-rich-quick scheme, just boring math quietly working in your favor. If this finally made investing click for you, subscribe, because next time we're settling one of the biggest questions in all of personal finance. Roth versus traditional, and which one actually leaves more money in your pocket? I'm Jake, and I'll see you in the next one.